All right, so I thought I'd start this series of videos on the stock market since I have a lot of people, a lot of friends that ask me about it. And if you're just sort of seeing what's on CNBC every day or the news, and you see the stock market go down a lot or go up a lot, you could think like, wow, the stock market's doing great, or wow, the stock market's doing bad. And the whole point behind this series, at least in terms of the S&P 500, which is what we're looking at here, I'm going to try to show you how it's more big picture stuff and how you should be invested in it for the long term. But then I'm going to show you in different videos if you want to do shorter term trades with stocks like Bitcoin stocks, like any stocks that you hear people talking about. I'll even show you the GameStop trade and stuff like that. And if you wanted to trade one of those, how I actually look at trading them now that I've learned sort of what I think is the best system I've come up with of trading, which is taking out all of the noise and trying to make sense of it by creating these signals that confirm my choice that I think is good or not. Okay, so what we're looking at here is the S&P 500. Each one of these little dots that you're looking at is 1 day of trading, okay? And I have this sort of custom code that makes either when it's bullish, really bullish, then the candles are going to be green. When it's really bearish, they're going to be red. When it's neutral, it's going to be yellow or orange, I believe, or maybe just yellow. So positive, negative, and neutral. But I don't put too much emphasis on that. I don't live and die by that. I'm more about this signal right here. So these two lines right here, the purple line is called the 200-day moving average. And that's basically taking the last 200 days and it's averaging them out using math and creating a line, okay, rather than looking at the noise of everyday days, if that makes sense. The blue one is a 225-day moving average. So it's going to move a little bit slower because it's using more days to average. The key to the system that I sort of believe in at this point is when you have one cross over the other, it creates this signal that I custom coded right here. So when you have the purple line, which is the 200-day moving average, cross above the 225-day moving average, the blue line, it's going to give you this positive signal right here. This, for all intents and purposes, is basically called a buy signal when it is above the moving averages. When it's below the moving averages and you have a red signal, then it would be a very bearish signal. So to make a long story short, I look at signals, or I look at the market to be in 4 different areas, either bullish, very bullish, bearish, or very bearish. And I'm going to show you where we are now and sort of how I figured this out. So what we're looking at here is back to 2018 or so. This is 2018, this is 2019, and this is where we are right now. This is 2019, this is 2020, and this is 2021 right now, okay? So this is the coronavirus sort of flash crash or crash of the stock market right here. This was a fairly big move. It was a 30% drawdown. That's pretty big for any time, really. To put that in perspective, Black Tuesday back in 1987, I think that was like a 23% move in one day. So if we're back here and we are in 2019, then I get a buy signal on the stock market here on August 19th. Okay, and the reason why is because we are above the 200-day moving average and the 225, and we have a cross. The purple goes above. That for me means we are very bullish. Okay, if we are just above the moving averages like we were here, but we are negative here, which means that we were actually reversed. The blue moving average was above the purple. That's, for me, is just bullish, okay? We're above the moving averages, but we don't have this as a confirmation yet. So as soon as we hit this, we're now in a confirmation, very bullish market. So what I wish I knew back then and what I know now is that I was definitely freaking out when all of this was happening. If I knew this back then, I would not have been freaking out. I would have been thinking that we were in what I call a bearish situation, but not a very bearish situation, because we were bearish here, but we did not get a cross in these moving averages, okay? It actually recovered very quickly, and before you know it, we were above the moving averages. So here, as soon as we reach here, we are now in bullish territory, but not very bullish. Note, okay? So we're doing really well. We're doing really well. This isn't like, I wouldn't trade. The indexes don't work as good as stocks in terms of like trading. This is just to sort of, if you're in the indexes or if you're in a 401k or whatnot, you're not really jumping in and out of the markets. This is just to show you where we are in the markets. Like I said, either very bullish, very bearish, or bearish. Either one of those, okay? Just so that you're not like thinking that we're just in like no man's land, like the market just moves up and down and who knows where it's going. Actually, it moves really slowly when you look at it from a big time frame. And obviously when you're looking back, it's one thing, there's a certain amount of, you have to be careful of confirmation bias, which is only looking for moments that work with your scenario. So then you think that every time it's going to happen after that, it's always going to work. This isn't confirmation bias. This is back testing a strategy and seeing that it works almost all the time. And I'll show you. So point being, as soon as we get to here, which is in September, we actually had a pretty deep dive in the markets. Again, you could be freaking out here if you were not looking at a chart that had moving averages and that had signals like this. So yes, we did have a cross in the moving averages. They crossed each other, but we were still above both moving averages. So for me, that's still bullish. This is negated at that point. This only matters to me if it happens below the moving averages. Okay, makes sense? So then as we get here and we get to December, middle of December, we actually get the cross that happens here, which is our bullish cross, and we're above the moving averages. So our big bull move actually started in December, and this is where we are now. So we got up here and we're sort of trading a little bit sideways right now, but we are in a very strong bullish market right now, and there's nothing to be afraid of. Could we have a big drop down that happens very quickly? Yes, but we'll either test these moving averages and bounce off of them, or we'll go through them and we'll turn into a bearish market. If we keep going and we get this signal below the moving averages, then we're going to be in a very bearish market, okay? And so let's look back at a few other times and see what we had. So this is a good example here. Let me zoom out a little bit, where we had a big bull run starting in 2016, okay? And it started here when we had our cross and we're above the moving averages. This is negated because we're not below the moving averages. This just kicked in because of a little bit of volatility or something, but we don't care because we're above, okay? And then it confirmed again right here. It established the move, okay? And then we continue this bull run all the way up here. Again, it goes all the way up. It comes back down. You could be thinking like, whoa, what's happening in my 401k? Or, should I be getting out of the markets? Nope, it just tests it and it bounces right off of it, tests it again. But we're still in this upward momentum, okay? We have not crossed over until finally we actually come below. So now we're in a bearish market right here, but not very bearish until we reach right here when we have our signal kick in. So here is a point at which, if I was some sort of investor that was hedging the market, if I was a 401k holder, but I had extra money on the side in my own trading account or something, and I wanted to hedge my 401k, because a 401k you're buying every week or every 2 weeks or every month. Your employer's doing it for you, and you're dollar cost averaging, which means that you're buying stocks no matter where they are, no matter how far down they go. You're just buying all the time, and that works great as well. This is just to show you, if you wanted to hedge the market, or if you just wanted to be aware of where the stock market is at any given point in time. So this would be a very bad time to be in the stock market, unless, like I said, you were buying all the time and you're in a 401k or you're dollar cost averaging buying. This would be for somebody that's trading a little bit more often, or wants to hedge their 401k and wants to be aggressive about it. So boom, we have the signal hit right here, okay? It actually has a pretty quick recovery, and then bang, we're above our moving averages right here. So now we're bullish, okay? We have a thing right here, a signal right here, but we're still above the moving averages, okay? We're bearish for a second, and then we pop right back above, and we're bullish again, and then bang, we get our bullish signal right here, and we're above the moving averages. So this would be a absolute prime time to buy back in, or buy back in short term. Now this is interesting because this is where the coronavirus hit right here, and you know this is a pretty painful thing. Like if you were to buy back in here and you were to ride this back down, you know that's a 25% pop. If you wanted to, you know, get out as soon as it goes under the moving averages, that's another thing that you can do as well. Or this is just for somebody that just wants to know where the stock market is at any given time, whether it's bearish or bullish or whatnot. Okay. Larger point being is that had I known this back then, I would not have even been freaking out about this. Okay, because as you can see, I scroll over, we actually never had a cross, never had a signal. We finally have a signal here, but who cares? We're above the moving averages. And bang, here's our amazing bull run that we've had since, you know, March or April of last year. Okay, if I go back a little bit further, let's just look at one other one. Let's look at an interesting one like 2000. Where is this? This is 2000. So we had the dot-com boom right here, and this was just a massive run up in the S&P, and I can't even zoom out all the way and have you see the whole thing, but this is starting in 1990. We actually get our buy signal right here, okay, and we never get, this happens right above, so it's negated. This happens above, or very darn close to being above, negated. And then we start this huge bull run starting here in 94, 95, 96, 97. We go below it, but again, we're just bearish for a second. We're not very bearish. This is not like sell everything you have and get out. And then we continue that up to 2000, and then we have a crash down. So I wanted to show you this because, you know, this is for somebody, like I said, that has a trading account or is just curious to see where, you know, the stock market is or whatnot and how good it's doing, because you could be looking at the markets and you could be thinking, you know, right here, like, oh, stock market's at its bottom, you know, it's time to buy in. Well, no, it's not. It's still below its moving averages, and we have this signal right here. This is in 2000, January of 2000. So we have our bearish signal right here. We're below the moving averages, and it continues to go down, continues. It's actually a 40% drop. Now you think maybe it's going above here, but we never get a solid confirmed buy back in until finally we become bullish. We finally make a break above the 200-day moving average, and then bang, we get our signal right here. So if you look at this as a buy opportunity, okay, or at least just whatever, knowing that the stock market's in a bullish trend, look at this move. Here we go. This is 2003, 2004, 2005, and bang, we keep going up, and we go all the way up to the housing crisis, bank crisis in 2007, and then we have, you know, it drops below the moving averages, and then our signal kicks in right here, and now we're in a very bearish, and that's a 50% drop. So I'm just saying, if you have, you know, a bunch of money in a trading account or whatever, and you're writing it out, that's one thing. If you want to protect your capital or hedge your capital in some other way, whenever this happens, this signal either going down or when this signal happens going up, it actually doesn't happen that often. So when it does happen, it's fairly important. Okay. So yeah, so that's it. Well, I'm going to get to talking about this signal and this signal a little bit in the next videos when I talk about individual stocks. But for now, hopefully this helps, and I'll try to do some updated videos specifically on the S&P 500, maybe once a month or whenever something important happens.